All right, so let's dive into this. Did you know there was $4.5 trillion? That's trillion with a T of trade credit just floating around the U.S. economy back in 2019. I
Wow.
know, right? It's a huge GE number.
Yeah.
To put it in perspective, that's like 21%, almost a quarter of the entire country's GDP.
That's incredible. It's like this massive financial engine that most people don't even realize is running, but it's so crucial for businesses.
Absolutely. It really is the lifeblood for a lot of companies, allowing them to keep things moving day to day.
Mhm.
We're talking about that system where businesses buy goods and services now and promise to pay their suppliers later. Trade credit.
Yeah, and for a lot of companies, that's their main source of short-term funding. It's more fundamental to their operations than we might think.
Totally. And for you listeners out there, we know that business finance can sometimes feel like, well, a bit of a black box. But we're here to shed some light on it. Today, we're going to unpack a really interesting connection, something you might not expect.
We're zeroing in on how a company's efforts to report its carbon emissions and make sure that information is trustworthy can actually impact its ability to get trade credit.
Exactly. So for this deep dive, we've been looking at this fascinating research paper. It's called Does Firm-Level Carbon Assurance Matter for Trade Credit? And it was published in Finance Research Letters.
And what's really interesting is that the study focuses specifically on U.S. publicly listed companies. So we're talking about real-world data, hard numbers.
Right. It's not just theory. And in the big picture, this is becoming more and more important because these days, companies are really under the microscope when it comes to their environmental impact. Investors, customers, everyone wants to know that they're being responsible.
Absolutely. And this research shows there's a real tangible financial benefit to having those verified environmental reports, easier access to that crucial short-term funding through trade credit.
So today, we're going to break down the why and the how. Why does getting your carbon emissions report checked and verified, what they call carbon assurance, actually make it easier to get credit from your suppliers? And how does that actually work in practice? We're cutting through the complexity to bring you the insights that matter.
Sounds good.
So to kick things off, maybe we can start with the basics. Why does trade credit even exist in the first place? The paper mentions a few key ideas, one of the most prominent being that suppliers are often in a much better position than a traditional bank to really understand their customers.
Right. Think about it. Your suppliers see your business up close. They see your order history. They know what's happening in your industry. They're going to have a much clearer picture of your financial health than some bank that just looks at a quarterly report, you know?
It's like they have this insider knowledge. They're taking on less risk because they know more.
Exactly. And from the buyer's side, they might rely on trade credit because they face what economists call information asymmetry with banks. That just means they know more about their own business than the bank does, which makes it harder to get a loan.
And that lack of information can make banks hesitant to lend, or they might charge higher interest rates to cover that perceived risk.
Precisely. And that's where trade credit becomes really attractive for some companies, even if it's not always the cheapest option.
That's a good point. But it's not always more expensive, right?
Yeah.
The research also mentions that companies with a good financial track record can sometimes get pretty favorable terms on their trade credit.
Yeah, it really depends. Suppliers want reliable customers, and they're willing to reward them with better terms. And that's where this whole idea of carbon assurance comes into play.
Because a company's commitment to environmental responsibility is a huge part of how trustworthy they seem to everyone, including their suppliers. And the paper talks about this growing pressure on companies to prove they're being responsible while still making a profit.
And while there's been research on the link between general ESG performance, environmental, social, and governance, or even broader CSR efforts, this paper really focuses in on the specific impact of carbon assurance.
So instead of looking at everything a company does, they're honing in on how credible their carbon emissions data is. And they make this really important point. Just reporting on sustainability isn't enough. It's the assurance that independent verification that makes a difference.
It's like getting a second opinion or an audit. When someone independent checks the data, it just adds a layer of trust that you don't get if the company is reporting on itself. Especially now with regulators like the SEC pushing for mandatory assurance on climate reporting, it's becoming even more important.
So how does this carbon assurance actually lead to more trade credit? The researchers found two main reasons. First, it reduces that information asymmetry.
Right. When a company has their emissions independently verified, it signals to suppliers that they're serious about their environmental performance and their data is reliable. It takes away some of the uncertainty.
Less uncertainty equals less risk.
Exactly. And the second reason is about managing risk, specifically the risk to the company's reputation and the risk of being accused of greenwashing.
Greenwashing, for those who aren't familiar, is basically making false or misleading claims about your environmental impact.
Right. And in a world where everyone's talking about sustainability, getting caught greenwashing can seriously damage a company's image. Carbon assurance helps protect against that.
So suppliers see a company with carbon assurance as a lower risk. They're more likely to be stable and less likely to face environmental fines or boycotts or whatever. All of that makes them a safer bet for offering credit.
And as the paper points out, that reduced information asymmetry can signal good things beyond just environmental stuff. It shows a commitment to transparency, which can lower investment risk in general.
So this research ties together two big trends: the focus on environmental responsibility and the importance of trade credit. It's showing us that being environmentally responsible and proving it can have real financial benefits.
It's one of the first studies to really zero in on carbon assurance specifically, which is a valuable contribution. We knew all sorts of internal and external factors mattered for trade credit, but this specific type of environmental accountability hadn't been studied as much.
And it emphasizes that assurance is key when it comes to sustainability reporting. It's not enough just to put the information out there. You have to make it trustworthy. This research suggests that can actually unlock financial benefits.
Perhaps most importantly for listeners, this study really connects non-financial reporting with financial outcomes. It shows that when a company's actions are audited and assured, that positive impact on their economic performance becomes more apparent.
So let's get into the nuts and bolts of the research. They looked at publicly traded companies in the U.S. from 2007 to 2020.
Their data on carbon assurance came from the CDP, formerly the Carbon Disclosure Project, and they got their financial data from CompassStat.
And because data on carbon assurance is still fairly new, they ended up with over 2,400 observations. Different companies, different years.
Their main measure of carbon assurance was what they called the carbon assurance percentage, basically. What proportion of a company's Scope 1 and Scope 2 emissions were verified?
Just to clarify for anyone who's not familiar, Scope 1 emissions are the direct emissions from things a company owns or controls, like factories or company vehicles. Scope 2 emissions come from the electricity and heating and cooling that the company buys. So it's a pretty big chunk of their carbon footprint.
They also looked at the carbon assurance level, which measures how extensive the verification was, ranging from no verification at all to a really high level.
And for trade credit, their main measure was how much a company owed to its suppliers compared to their sales. But they also used other ways of measuring trade credit, like accounts payable relative to their cost of goods sold, just to be sure their findings were robust.
And of course, they took into account all kinds of other things that could affect how much trade credit a company gets: size, profitability, debt levels, investments, cash on hand, and so on. That way, they could really isolate the impact of carbon assurance.
And what did they find?
Well, their initial analysis showed a clear positive link between carbon assurance and trade credit. This was consistent across different statistical methods. So companies with more carbon assurance tended to get more trade credit.
And it wasn't just statistically significant, it was economically significant too. A 1 standard deviation increase in carbon assurance percentage was linked to something like a 2% increase in trade credit. And that's not insignificant when we're talking about a company's short-term finances.
To make sure their findings were solid, they did a bunch of robustness checks. They used different ways of measuring both carbon assurance and trade credit, and the positive relationship held up.
They also looked at whether the level of competition in the market or the political environment, like whether a company was in a red state or a blue state, had any effect.
Interestingly, while that positive link was generally there, it wasn't always statistically significant in every variation of their analysis. So the strength of that relationship might be influenced by these external factors.
Here's a really intriguing finding. That connection between carbon assurance and more trade credit was mostly seen in companies that are not in carbon-intensive industries, like energy, utilities, materials, those heavy emitters. For those companies, there wasn't a significant relationship.
That raises the question, why might that be? The researchers speculate that suppliers in those industries dealing with emissions every day might just be more skeptical of carbon assurance as a signal of lower risk. They understand the complexities better than anyone.
To be extra sure that carbon assurance was the cause and not the effect, the researchers used some pretty advanced statistical techniques. They wanted to rule out the possibility that something else was driving both.
They used a few different methods, like instrumental variables. Basically, they looked for things that would make a company more likely to get carbon assurance but wouldn't directly impact their trade credit. Things like the average carbon assurance level in the industry, or whether they were in a state that participated in the regional greenhouse gas initiative.
They also use something called propensity score matching, which creates comparable groups of companies with and without carbon assurance. And they even use the Heckman two-stage selection test, which accounts for the possibility that companies choosing to get carbon assurance might be different in other ways.
The point is, all these different tests pointed to the same thing. Carbon assurance leads to more trade credit.
Finally, the researchers wanted to understand the why. They did something called a channel analysis to see if reduced risk and information asymmetry were really the drivers.
They looked at measures of both accounting risk, how much a company's returns varied, and market risk, how volatile their stock price was. And they found that carbon assurance was linked to lower levels of both. So it really does seem to reduce overall financial risk.
And to assess information asymmetry, they looked at analysts following how many analysts were covering the company and how accurate their earnings forecasts were.
And companies with carbon assurance tended to have more analyst coverage and more accurate forecasts, which suggests a more transparent flow of information.
So to sum it all up, this research found that companies that get their carbon emissions reporting verified tend to get more trade credit. And it's likely because that verification reduces risk and improves transparency, making them seem like safer bets for suppliers.
Exactly. And this wasn't just a small effect either. We're talking about a potentially significant increase in available credit. Plus, those findings held up even when they used different measures and accounted for other factors.
Now, it's worth remembering that that positive relationship was strongest for companies in less carbon-intensive industries. So there's still more to explore there.
Absolutely. And the fact that the researchers took all those steps to address potential bias in their analysis really strengthens their conclusions.
So here's something to ponder. With climate change being such a hot topic, no pun intended, and carbon reporting potentially becoming mandatory, how do you think this connection between carbon assurance and access to financing is going to evolve?
It's a great question. Could we see similar effects from other types of non-financial disclosures? What else might start influencing a company's financial health in the future?
Food for thought. If you're interested in learning more, we encourage you to dig deeper into trade credit, carbon assurance, and the role of ESG in finance. Understanding these trends can give you a real edge in today's business world.
Definitely. Thanks for listening.
And thanks for joining us on this deep dive.